Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Tchir of Academy writing the following: while the market is right not to get too concerned at the moment, there is a risk that it's being very complacent. Pete joins us now for more. Pete, good morning.
Hey, good morning.
That risk always exists. Let's talk about whether the base case right now is justified or complacent.
I think it's heading towards complacent. I think the administration seems very comfortable with tariffs. They're coming out, talking about them. Let's not forget, Trump, he really liked tariffs. And I think this whole taco thing is overdone. I think he pivoted, right? It wasn't going well. Stock market was coming down. He had other things to focus on. He pulled back. Now he's had a few big wins. I think the success that we had in Iran, very positive for him. Getting NATO to agree to 5% except for Spain, that was very positive for him. Getting the big, beautiful bill turned into an actual law was positive. I think he's going to take another cut at this. And the problem is, I think for markets, we're not going to get a quick reaction. We might not even get a reaction after August 1st, assuming the tariffs go in. Because last time the tariffs were actually in, I believe, for some number of hours before they pulled back. So I think this could drag on. I think it's going to be more of a slow bleed, unfortunately.
There's a larger question here. Is this just the market saying, look, we've been fooled before. What are you doing? We're not going to buy into these rates actually going through. Or is this a market saying, we've seen how companies absorb these tariffs, and it isn't going to be as big of a hit as many people initially thought?
I think it's the former. I think people are just like, we got fooled by this. We all got panicked. We all believed the Main Street versus Wall Street, the rhetoric that was coming out of the administration, that they would go forward. I think when you start seeing this, one, it's too early to expect much of a hit onto Wall Street, right? Even at 10%, companies had a lot of ability to pre-order stuff. That helped take care of it. You've seen a lot of USMCA goods get compliant, approved as USMCA compliant. That's reduced effective tariffs. And you look at the tariff revenue, I think it's about $80 billion over the last 3 months. That's a drop in the bucket in terms of inflation or anything. So I think we will not start seeing the inflation effects or the impact on corporate earnings until a few more months down the road.
Which is the reason why we've been talking about how pivotal this week is. How much are you concerned about it being a head fake if we don't see the real ramifications from tariffs, either in consumer inflation or in bank earnings in particular?
I'm not as worried about the earnings. What I'm looking for a little bit is what are people seeing globally? What's the global economy looking like? We talk so much about the domestic economy. What's it like? What's spending going on? And are any of the U.S. brands seeing a pullback in spending? That to me is one thing. We've seen it in tourism. Is it more widespread? Because that would be a bigger concern to me, that you're starting to see this kind of pulling away from the American brands, which would be very consistent now with what you're reporting this morning, that other countries are trying to figure out, okay, what trade deals can we do away from the U.S.?
So what do you like then in this moment if you don't think the president is just in negotiating mode and potentially some of these rates can stay?
So I still like anything that's really involved around national security, national production, right? And I think last week we saw MP, with ticker symbol, got an investment from the Department of Defense. It was a little bit ad hoc that the Department of Defense had that money, but maybe we start seeing the sovereign wealth funds, that we talked about at the start of the administration, start turning into something where you start seeing investment where the U.S. public actually gets to take advantage of the growth. We have to have rare earths and critical minerals, and not just the commodities, the processed and refined versions of those. We need chips, we need pharma. All those things, I think, that's where I want to focus, because the president could juggle two things, right? Push hard on tariffs on the one side, domestic growth, and those things do take away jobs from China. They bring jobs to the U.S., so they fit a lot of agendas. A lot of it's deregulation, which, again, is right up the president's alley. So that, to me, is a positive. That last week in that investment by the Department of Defense is just the tip of the iceberg.
So you think the 50% tariffs on copper is good and it stays?
I don't know that it's good at all. Again, it's something we import a lot of, and we need to, and we're not going to be able to turn it back. But yeah, I think he stays. I think he tries to grow some domestic businesses around that. But it's going to come through investments, not going to come out through handouts or subsidies.
Quick final word on CPI tomorrow morning. We've had a string of softer than expected reads. Do we get a fifth tomorrow morning?
I don't think so. I think we've kind of bottomed out on it for a little while. I think there's been some pressure on, through some of what's been going on in the USMCA. I think people push some prices through. So I'm not alarmed, but I don't think we get a good number.
Vito Sperduto, the Fed has a lot to answer for. Where's this one going?
I have no idea. It does feel politically that he's going to be under a lot of pressure in the coming days, weeks. And I do think he probably should have cut rates or be on the pace. We should be cutting in July, I think. I don't like the jobs data. So I don't agree with all this policy, but I think pushing him out and this pressure, markets aren't going to like it. The world's not going to like it. So I don't love that strategy.
What do you think the cost is? What's the price of firing the Fed chair? I'm not saying it will happen. If it happens, what is the cost? And is it so high that it prevents it from happening?
Unfortunately, I don't think it's going to be that high. Front-end yields probably go down, right? Because whoever's going to come in is probably going to implement cutting. You see yields go higher maybe at the back end, but how much can twos, tens go out? So I think it's actually going to be a muted reaction. I think there's a lot of fear that we're going to blow up the Treasury market. I just don't think that happens right away.
And part of the reason why is because people say there's a whole committee full of Fed members that all have a vote. And yet Kevin Warsh, who previously was on the Fed Board of Governors, came out and said, we need regime change. We need an overhaul, and started talking about the strategic shift that he would like to see at the Federal Reserve. How realistic, how feasible is that?
I've often wondered for the last decade why we don't have more behavioral economists on the Fed, right? We have the traditional macroeconomists, and yet when you look at the Nobel Prizes, they're going out to the behavioral. So I think a shake-up and kind of some different thinking wouldn't be a bad idea. Again, I'm not sure that it should be done in this kind of, very quick and rough way. But I think there are things. How do we think about the world? How do people respond? I think a lot of traditional macroeconomics has failed us, and we've kind of missed the GFC. We missed the European debt crisis. So bringing some new types of thinking might not be a bad idea.
There are two things that you're sort of alluding to here. And one is the fundamental economic justification for both a rate cut and a rethink of some of the economic modeling on the Fed. The other is the political jawboning that leaves people concerned about a Turkey situation, Erdogan-like pressure, talking about what happened with Arthur Burns that led to the highest pace of inflation that we've seen in modern history in the United States. So how do you distinguish between the two, and does this kind of pressure make it less likely that they can cut in a way that might be appropriate economically?
So I would have said before this weekend, I felt they would be pressured not to cut because they didn't want to be bowing to this. But it does seem like this is a whole new line of attack. They're kind of going down different avenues to get that sort of change. And if that happens, then I think we do get cuts very quickly, because whoever comes in will try and say, well, this has to be our mandate. It's probably the most confusing I've ever had, because we've never, I think, had to figure out the political ramifications of the Fed in such a way.
Kevin Hassett was asked about this over the weekend. He says they're being looked into, whether or not if there's cause, he could be fired. But this would be about issues regarding renovations at the Fed. Does it matter to the markets what the potential issue is that they think they have a legal standing to fire the Fed chair?
I think it does make a difference. And I do think one thing, Powell was very successful independently before he joined the Fed. So I think he probably has a lot more stomach to fight this than someone who didn't have, his own personal wealth, isn't coming into this job very strong. I think he is very committed to what he's doing. So, I find he will not go down easily.
If he's not going to go down easily, then do you think he sticks around to finish out his governorship to 2028?
I think that's such a long way away in this environment right now. It's like we have trouble living week to week.
Right, but he won't tell Trump administration officials, he won't tell reporters. He's repeatedly asked about this and doesn't give an answer.
I think there's no reason for him to give an answer. Why make it easy on anyone? It's his kind of little bit of leverage. Maybe it's what makes him happy when he's fighting with this. So I feel it's all a bit of a sideshow to what we should be looking at, and that's not good.
The price of this. Now, you said it wouldn't be that high. George Saravello said it's 30 to 40 basis points in a fixed income sell-off in the following 24 hours. For the FX market, it could mean a 3 to 4% move in the trade-weighted dollar. Lisa brought up the experience in Turkey. If you go back to spring of 2021, when Erdogan fired his then central bank governor, I think the following day we had an 8% move on the Turkish lira. Are you not expecting anything like that in the following 24 hours?
I think it'll be hard. Like, you want to sell off. I think that I agree on the FX. I think it's going to push people away from the dollar. I think that makes sense to me. But why would T-bills sell off a lot, right? Clearly, you're going to get someone coming in, and I think that will anchor the curve a little bit. I think maybe you get this
initial... anchor the front end. Tell me what happens further out along the curve. I'm not interested in the front end. I want to know what happens to 10s and 30s.
Maybe it widens a little bit. I don't see a 30 to 40 bip. I would not be surprised to see markets actually remain more calm than all the hype, unfortunately. Well, I think that gives the whole ammunition, but I think there's just so much more going on than the Fed share. Now, if we believe that someone's going to come in and cut 100 bips immediately and get us down to 2%, that's a different story. But I think if you think someone's going to cut 50 and try and get down 100 bips by September, do we really sell off that much? Like, that's kind of more in the ballpark what I think the Fed should be doing anyway, so I'm not going to react that negatively.
Are we setting, though, a precedent that becomes dangerous for the bond market going forward? And I say this not just from a U.S. perspective, but globally, at a time when you see all of the long bonds around the world and developed markets selling off in the prospect of more spending and politicians that don't want to have to raise taxes or cut spending in order to reduce the deficit. Isn't this a fundamental problem that increasingly politicians will just jawbone their central banks as opposed to actually taking the pain?
Yeah, and I think it's like a lot of things. We've had executive orders skyrocket over the last 20 years. Everything's kind of being done a little bit backdoor, maybe not quite by the official channels. So I think those are all risks. One thing I keep, we've been arguing to our customers probably for 3 years now. You're supposed to be, if you're investing in 1 year and in paper, heavily overweighted towards corporate debt, commercial paper, because corporations actually have good governance, right? Corporations that are there to make sure their bills are paid on time. So I would be overweight. I think you're getting that extra spread, and I think there's going to be more and more conversation about what should one of these top companies trade versus the U.S. dollar, versus T-bills. I don't think we're
trade through.
I don't think we're there at this point, but I could see us approaching that, right? It's happened in some, third world or EM countries in the past for a variety of reasons. We're not there, but I think you're getting free spread almost when you look at some of these AA, AAA, even single A companies who are issuing commercial paper. I would own that all day long instead of T-bills. I think it's less hassle.
Peter, if you don't think there's going to be a massive implication to the markets if they fire Fed Chair Jay Powell, what's holding them back then from doing it?
I assume there's legalities in how to do it, whether they're allowed to do it, and I'm sure that's being worked on.
Pete, it's good to see you, as always. Thanks for dropping by. Peter Tchir there of Academy. The former senior White House trade advisor Kellyanne Shaw writing, the president believes he still has a long leash when it comes to tariffs. For countries that don't have deals by August 1st, I do expect tariffs to go up. Kellyanne joins us now for more. Kellyanne, welcome back to the program. I think you told us all to get a beer and take a break last time, and then everyone gets fired up after the announcements over the weekend. How seriously are you taking some of the threats this past weekend?
Yeah, good morning. And I think I have the same advice today that I had last week in that, this is not for us. This is not for business. These tactics are really for other governments. And I think that Director Hassett said it well on Sunday when he said the president was trying to squeeze every last drop out of some of these deals. So that to me is really what these letters are about. I'm still relatively optimistic we'll land somewhere with the European Union. The Mexico letter was a bit of a surprise to me, given that they weren't negotiating one of these full reciprocal deals. It was really about steel and aluminum. But that said, we've got 2.5 weeks to go, and I expect to see a bunch of deals. And for those countries that don't have them, I expect to see those tariff rates go up.
When you say you do think this is the president trying to squeeze every last ounce out of these trade negotiations, say it comes to the European Union, what is he after?
Well, with the European Union, there are a number of sticking points. And I think everyone's expectation is that if the U.S. and EU were going to be in a position to agree, that it would be to basically a subset of issues and not every irritant. But I had been hearing some consternation about agriculture in particular and some frustration on the U.S. side that the EU wasn't willing to cut some of the more sensitive tariff rates. And then a lot of disagreement over those Section 232 carve-outs and what those might look like on auto, steel, pharma, semiconductors. And then, of course, the president has long talked about Europe's treatment of U.S. tech firms and from state aid to the DMA and DSA. And so those are going to continue to be difficult points between the U.S. and the European Union.
The European Union, we have a story, is preparing to step up engagement with other countries, potentially approach the United States with other allies. Do you think that tactic could work with this administration?
I think it is a unique administration who negotiates in ways that are not typical in terms of diplomatic relations. So why not? Why not come to the United States as a bloc and say, here is a potential solution and a potential way forward? Because what is clear from President Trump's tactic in terms of taking the sledgehammer to the global trading system and negotiating bilaterally with every government on earth is that the current global trading system, the World Trade Organization that is 166 member countries, just doesn't work. And so if there are a subset of countries who want to join together and approach the United States, I think the administration could be open to that.
Kellyanne, you said a key word there, tactic. And this is what the market is viewing all of this as, at least in terms of the muted reaction that we're seeing this morning, a tactic to negotiate a better deal. Is this negotiating with the trade partners or is this negotiating with the market?
I think it's predominantly negotiating with the trading partners, but I do think that the market is playing a role. And right now, the fact that the market hasn't reacted as significantly as it did in the aftermath of April 2nd, coupled with low inflation, positive job reports, and overall good economic indicators, I think does embolden the president and gives him a longer leash on his tariff strategy. Now, if the markets were to totally go the other way, I do think that that might have a bit of a mitigating impact on some of these tariffs. But I think the market is reading the situation exactly right, which is the president is sending these letters out, announcing these high tariff rates in the hopes of actually getting deals so that he won't have to impose those tariffs.
So, Kellyanne, that's where I think there is some confusion. What is the tariff strategy? Is it to get deals that are specific and have certain parameters, or is it just to see how far someone can push before you get revenues on the tariff side and markets don't freak out?
Yeah, I think it can be a little bit of both. I mean, certainly the pressing task right now is to create this action-forcing event that by August 1st, these tariff rates will be exceptionally high unless countries are able to get a deal. I think that's really first and foremost on the president's mind. But the second line of messaging that we're hearing is about this revenue and the fact that the tariffs have been good for the U.S. economy, that prices haven't gone up, and we're going to use it to pay for some of these tax cuts. I think that's about softening the message on tariffs so that for countries that don't get deals, it's not viewed as catastrophic, the sky is falling, that there might be some positive benefit there. But I do think at the end of the day, it would be best case scenario for everyone involved to find some sort of landing zone in terms of these bilateral negotiations with countries and to see a bunch of deals get inked and see those tariff and non-tariff barriers come down.
Kellyanne, appreciate the update, the catch-up. Thank you. The former senior White House trade advisor, Kellyanne Shaw, there on the latest. Vito Sperduto of RBC Capital Markets saying M&A activity is delayed, not derailed. Writing the backlog of M&A opportunities continues to build. Deals will happen. They're just not happening as quickly as many had expected. Vito, it's good to see you. Good morning.
Thank you for having me.
The difference between those two words, delayed and derailed. What inspires confidence that this is just a delay and not a derailment?
Well, I think the fundamental conditions have continued to be very solid. I think the corporates are sitting flush with cash, more so than they have historically. I think for clients, for instance, we're open to lend to clients to support their transactions, much like we were earlier in the year. I think people have gotten comfortable with the current environment. They are operating in an environment of constant uncertainty. And so when you talk about whether it's tariffs or other policy coming out of D.C., you have to plan for multiple scenarios. And so what we're finding with our clients is that they're preparing for transactions. There's a fair amount that they'd like to do. They're continuing their plans. It's just a question of when do you make the decision to do it. And so it's delayed to the right. It's not being taken off the table. And so I think there's a fair amount of activity when the window does open.
A lot of people said it was a wait and see economy, and then Delta Airlines happened. And Ed Bastian came out and said that things are stable, businesses have clarity, they're investing again. Have we broken out of that wait-and-see economy?
I think some have. I think we're seeing it certainly. I take a look very closely, for example, at the CEO Confidence Index out of the Conference Board. So the median there is 50 on a scale of 0 to 100 in terms of the inflection point. In the first quarter, which was taken in February, CEOs were at a 60, meaning that they were confident in the forward outlook. They felt positive about it. The survey that was taken in mid-May dropped to 34. It's the biggest quarterly drop that you've seen. So what happened between February and May? Liberation Day. So that tariff and policy uncertainty, concerns about geopolitical instability, and then also an uncertain regulatory environment in some cases has driven them to not make decisions. And so when they looked at that, a very high number of them felt that we were in a worse position versus 6 months ago back in May. But what we are seeing is that, look, I think you look to Trump 1.0 versus this, it took a full year of the first administration for people to get their arms around what it meant. I think it's happening quicker now, and I think the better companies are prepared and they're going to enact policy.
The pipeline is rich. The pipeline is there. Look, I think that one reason why a lot of people are looking at this is because we are going to get the earnings from JP Morgan and Citi tomorrow, and Wells Fargo, and then from Morgan Stanley and Goldman Sachs on Wednesday. And people are wondering how much of a boom this is going to be to them, considering that heading into this year, it was supposed to be the year of M&A. Didn't happen. How much has that been derailed?
Well, I think you're seeing, if you look at M&A volumes this year, announced volumes, it's actually up versus last year. But a lot of those transactions in the first quarter were things that were already on the books about to happen. And so you have U.S. M&A announced volumes are up 16% this year. Globally, it's up 26%. But it's really larger deals, billion-dollar plus, are driving that. And the smaller deals, sub $1 billion, are actually slightly down in value. So what's happened is a lot of it's just been, like we talked about, pushed to the right. People should not be surprised by this. Like I said just now, this is what happened back in 2017 during the first administration. But what we are seeing is that where we sit today versus the beginning of the year is that there has been a tightening of the bid-ask spread. I think parties that are prepared and feel confident are out there doing transactions. I think sellers that need capital and need to, for instance, if you're a private equity firm and you need to return capital to your LPs, you're looking at various alternatives. It might not be a traditional sale, but maybe you look at a continuation vehicle. Maybe you're looking at some structured equity. Maybe you're looking at a minority sale or taking a loan on your net asset value. And you're finding ways to return capital because that's the lifeblood of what they need to do.
I wonder how much the scenario for how people are financing these purchases has changed with yields where they are. Have you seen people less willing, or companies, not people, companies less willing to incur debt to make those purchases and wanting to do it in all stock or crash or whatever just simply because of the fees?
I think if you go back 2 years ago, a year ago certainly, I think people had not accepted this new level yet. I think they've accepted it now. So they understand rates higher for longer. I think if you look at where the calls are, for instance, our rate desk just pushed out their call last week that instead of a first cut happening in September, it's now going to be December. Just because it's too short of a window to August 1st or to the September meeting to really see any statistics that will allow the Fed to cut. And so as a result, I think companies are saying, I'm going to be in this environment longer. I need to make the right decisions for my business. It's too soon to just focus on 26 and beyond, but I think a lot of folks are looking at their more longer-term plans. And as a result, you're seeing them make decisions that are strategic. I always like to say good strategic transactions will happen, and we can find a way to support them and finance them. And we're seeing that with our best clients.
But Vito, what's the risks in delaying?
The risk in delaying is that someone else takes advantage and you're sitting on the sideline and left behind. And so we're seeing a lot of activity in some sectors where folks are feeling that, for example, if you look at the technology sector, I think folks are trying to build their pipelines from an AI perspective, and they're looking and saying, I need to be in here quickly. I can't wait to develop this on my own. I'm going to acquire it. If you think about some other sectors like industrials, they're looking to diversify their supply chains and think about making sure they've got ample supply in various geographies, and so that they're tariff resistant. And they know they have to operate in this environment. We know it's going to not necessarily be what's out there in terms of a headline today, but we don't know what that's going to be. And I think they're planning for various scenarios.
Just finally, Lisa brought up the price of money. Do rate cuts make a difference? Do they move the dial?
I think, as I started before, I said we're looking for a signal for sort of people to make decisions. I think certainly rate cuts would be a good signal to the market and to buyers and sellers that this is an environment where we're ready to transact, and there's a level of confidence there. M&A is about aligning many different factors. And so you need your management teams, you need your boards, you need them all to have confidence in the forward outlook. If they feel that the Fed's giving a strong signal like that, I think that's a positive. But at the same time, I think the better companies are prepared to act in this environment. And so, again, I jokingly say we always have a pretty full pipeline. It's pretty full right now, but I'd love to see a lot of that transition to announced transactions.
You're certainly not alone. It's good to see you, sir. Thanks for dropping by.
Thank you for having me.
Vito Sperduto there of RBC. of Roth Capital writing this. Given the Fed's wait-and-see approach, prospective CPI readings may take on greater importance for risk assets in the months ahead. Mike joins us now for more. Mike, welcome to the program, sir. What are you expecting tomorrow morning?
Thank you for having me back on. So consensus is expecting a 0.3 rise, both headline and core. So I don't really think that is going to change the mood on the Fed. It's a very divided committee, as you guys were just discussing. I'm not super worried about a big inflation spike here. And the reason I say that is bond market inflation expectations are very low and steady. Some of the higher frequency data actually looks pretty good. There's a gauge called Trueflation, which is based on 80 million prices in blockchain technology. Super high frequency. So we have, year over year readings extending into almost mid-July here, 1.7%. So I don't think we need to worry about a repeat of that 3-year inflation overshoot, which was really an aggregate demand monetary policy story. The tariffs could definitely create some inflationary headwinds, but I think they are temporary, and the Fed probably is best to just look through them.
If that's the case, Mike, do you see this as a time for the Fed to be cutting, especially if this CPI print that we get tomorrow shows that ongoing disinflation, or at least not an inflationary trend?
Yeah, I think so. I think they're getting much closer to that point. Probably September. That's what markets are priced for. Fed funds futures are priced for just under 100 basis points of rate cuts over the next year. That sounds like a lot, but it's really not over a 12-month period if the economy is softening a bit at the margin. And I think, some of the data suggests that's the case. Not falling off a cliff for sure, but we are seeing a little bit of softness at the margin with, the most recent jobs numbers. And also, it looks like GDP underlying growth, real final sales to the private sector probably ran around 1% or so in Q2. So that's much softer than what we've seen over the course of the last 2+ years. So I don't think it's inappropriate for the Fed to be starting to consider lowering policy rates here. But I will say this, the hectoring from the White House is wholly unhelpful. I mean, even if the administration were to convince Powell to step away from the Fed and, this stuff about the construction project is just a fig leaf, it's pretty obvious what's going on here. It's completely out of line in my view. But even if you were able to convince Powell to step down and someone else takes over, it's a committee. They operate by consensus. So it's really very unlikely to dramatically change the rate path in any event. So
hold on a second, Michael, because this is actually one key question that the market has, right? That people are questioning whether the market is pricing in some sort of firing of Fed Chair Jay Powell, and would it have that big of a reaction at all? Peter Tchir was saying no, that it is a committee and that people would look through that. How much does it complicate a message that actually would go the president's way if he followed the economic data, at least in your opinion? How much does it complicate that kind of messaging from a Fed that wants to appear independent?
Yeah, that's a great point. I think, if anything, this hectoring and the political pressure probably makes it more difficult for the committee to move forward with rate cuts. And because they don't want to be viewed as, a bending to political pressure. So I think, if anything, these kinds of shenanigans are likely to backfire. And it sets a terrible precedent going forward. I mean, the Fed should be an independent institution. We can look back at what happened with President Nixon when he pressured Fed Chair Burns to inappropriately run easy monetary policy, setting off a decade of inflation, which eventually culminated in double-digit interest rates. We saw a situation in Turkey where President Erdogan tampered with the central bank, wanted low rates, easy money policy, a currency collapse, and hyperinflation followed. So let's get back to basics. If you want low market interest rates, what do you need? You need price stability, and I think the Fed is well on their way to achieving that in terms of on-target inflation. And you need budget integrity. And the Fed has nothing to do with that, in the administration, in my judgment, and Congress are certainly not on that path with the so-called big, beautiful bill that was miles and miles away from an optimal outcome.
Jonathan's been talking about this Deutsche Bank note about the risks of, if Powell was to be ousted, are underpriced. What kind of market reaction could we see if we've come to that point?
Well, it's very uncertain. I think it's just a matter of setting a very bad precedent of political tampering, or the attempt to tamper with an independent Federal Reserve. And you look back at history, and politicized central banks don't achieve optimal outcomes. They might do something that helps the sitting administration in the short run. In the long-term, price is paid by the public in terms of higher inflation and lower real income. So it's really not the path you want to be going down. Very hard to say in terms of the very short term. I mean, what happens even if Powell were to step down? I don't think it really changes things dramatically in terms of where the Fed is headed here, given that it's a committee, and the administration's not going to be able to completely politicize a majority on the committee anytime soon. That said, it's really a move in the wrong direction. It's totally inappropriate, and they should just stop it.
Mike, just to put a bow on it, given all the risks we've talked about, why are market-based inflation expectations so well anchored?
Well, I think they're well anchored because the Fed has achieved quite a bit of credibility here, right? I mean, they obviously had a big goof in 21, 22, where we had inflation shoot up to 40-year highs. But, they ended up correcting that with 550 basis points of rate hikes, and were somehow able to achieve a soft landing, avoid a recession, and now inflation has come down to much lower levels historically. So the bond market is giving the Fed the benefit of the doubt. The institution has really regained and re-anchored its credibility, and that's another reason not to tamper with the Federal Reserve in a political way, because if that credibility is lost, it could be very difficult to re-achieve. They certainly got very fortunate with this episode a few years ago. Why keep playing Russian roulette with credibility? It doesn't make any sense whatsoever.
Mike, appreciate your time. It's been too long. Let's do it again soon. Michael Darda there of Roth Capital.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.